All right, so chapter 21 is variable costing for management analysis. You can read that right on the board because you're intelligent people who know how to read. Yeah, okay, well, you know how to read. How about that? Let's see. So we've learned now about both types of costing systems, okay? Absorption costing and variable costing. And so absorption costing is where you take all of this overhead cost, right? And you roll it into the product cost. It becomes part of the cost of goods sold. That's kind of what we started this whole class with. This, I remember, and we went through all these different chapters of different ways to put the manufacturing overhead in. And so absorption costing is required for external reporting. So GAAP, generally accepted accounting principles, require us to roll those costs into the product costs. But variable costing is often much better for making management decisions because it pulls those fixed costs out from the variable costs, and then we can use cost volume profit analysis to make decisions about pricing and other stuff like that. And so the whole reason really that we have two different courses, a financial accounting course and a managerial accounting course, is because some things are required for reporting when you're going to release public information out, especially for publicly traded companies. But also if you're going to, even to do your taxes, you have to record certain costs certain ways. But others are better for making decisions. And so we end up having to have, you don't want to say two sets of books. That sounds like you're committing fraud, but you kind of have two sets of books. You have the ones that's reporting information, and then the ones that you're using for internal decision making. It's all the same data. It's just parsing it up in different ways that are better for making decisions. Right, we separate out variable factory overhead and fixed factory overhead. So we're just looking at the variable costs together, and then right. And so here's this whole chapter is about kind of exploring how the two turn out differently, okay? Because with variable costing, the fixed overhead becomes a period expense rather than part of our cost of goods sold. And by a period expense, it means we just take it as an expense that period. So think of what that means. What it means is under one method, this fixed overhead is going to be rolled into the price of the inventory. Right. And so then it's going to just be inventory. It's going to be an asset till we sell the inventory. Then it's going to become cost of goods sold. In this situation, the fixed factory overhead's not going to get rolled into the cost of the inventory. It's just going to be taken as an expense. So depending on which method we're using, we could end up with different net incomes because we're going to have different expenses. Here, we're taking the expense for sure. Here, we're only taking the expense if we sell the product. Okay. And so let's see. This is kind of a review. We've seen this lots of times now. Here's an absorption costing, a very simplified absorption costing income statement. We have our sales, our cost of goods sold gives us our gross profit. Oh, that's bouncy. And then our selling and administrative expenses gives us our operating income, right? So sales minus cost of goods sold, gross profit minus selling and administrative expense, operating income. But with a variable costing statement, and they actually broke this one down slightly different than the most of them we've seen because they put the variable cost of goods sold and the variable and selling and administrative expense, and instead of just lumping all variable together, but it's the same thing. So in essence, we have sales minus our variable cost gives us our contribution margin, minus our fixed costs gives us our operating income. So here's kind of the crux of this chapter is if the number of units we manufacture equals the number of units we sold, that means our inventory is not going to change. Okay. So if I had 10,000 units of inventory and I produced 100,000 during the period and sold 100,000 during the period, I'll still have 10,000 units of inventory at the end of the period, right? Because I sold everything I made. But if I manufacture more than I sell, then my inventory is going to increase. I'll have more inventory at the end of the period. And if I manufacture less than I sell, then my inventory is going to decrease, right? Because I'm going to use up some of the inventory that was sitting there before, plus all the stuff I made during the period. And so this is going to lead to some interesting differences between absorption and variable costing. So now we're going to spell it out. When the number of units manufactured equals the number of units sold, operating income will be the same under both methods, both absorption and variable. But when units manufactured exceed the units sold, the variable costing operating income will be less than it is for absorption costing. And I'll walk you through why in just a second here. So let's kind of look at this. Assume that we manufacture 15,000 units in a period, but we only sell 12,000 of them. That means we would expect to see our inventory go up by 3,000 units. Does that make sense? Everybody follow that to this point? Okay. All right. So this is a little confusing because they've got a lot on the slide, but let's just take a look at it. So under variable costing, we have our sales, our variable costs, and don't worry about this whole manufacturing margin. Let's just go sales, our variable costs, sales minus variable costs gives us contribution margin, okay? And then minus fixed costs gives us operating income. So you can see right on the variable costing income statement, we've got $150,000 in fixed costs. But on an absorption costing income statement, we're not going to have those fixed costs broken out. Instead, those fixed costs are going to be part of our cost of goods sold, right? Because with absorption costing, what we did is we used one method or another, because we learned about a couple of them, to allocate all those fixed costs into the cost of the goods manufactured. Okay, so we're going to end up with an operating income that is $30,000 different between the two. And so the question is, where's that $30,000? And the answer is, they have it on here for us easy. I don't think they do have it on here easy for us. It's sitting there in this ending inventory. Okay, because here we took the full fixed manufacturing cost of $150,000 as a period cost, but here we rolled the fixed manufacturing into the cost of goods manufactured, and so we're only taking that expense in as much as we're selling those units. The fact that there's 3,000 units being sold that are not being sold, that we didn't sell, right? We produced 15 but only sold 12, is where that additional expense is. We're still going to take the full expense of it. It's just that we won't get that expense until the next period when we sell those additional 3,000 units. So we're spreading that out. Yeah, Arthur. Right. So it's $10 per unit in fixed. Because if you think about it, if we produce 15,000 units, I guess I thought I was going to go back, but if we produce 15,000 units and our fixed manufacturing costs were $150,000, it means there was $10 per unit of fixed costs put into the cost of the units under the absorption costing. So the fact that there's 3,000 units sitting there is going to lead to a cost of $30,000 less. Right. So this becomes important, okay? Because when we're trying to make decisions using this data, we have to recognize that the difference between variable costing and absorption costing, that we're going to have a difference in net income or operating income, and that's going to be based on the number of units still sitting in inventory at the end of the period and the fixed costs that were absorbed into those units. Yes, so absorption costing is what is used for GAAP, generally accepted accounting principles. So for public reporting of information. Right. So this is interesting, right? So in this scenario where we produced more units than we sold, it leads to us having a higher net income under absorption costing than we do under variable costing, which means our income statements we're putting out for investors, lenders, and all those people are going to show a higher profit than the ones we're using for internal decision making. You are. But now, you know, ramp this up to the scale of a manufacturer like Tesla or, you know, any of the major automobile. Right. Right. Well, then the profit's still there. The question is, where should we take these fixed costs? Should we take them as a period cost? Because, or should we roll it into the price of it? And GAAP says you should roll it into the price because they're manufacturing costs, so they're a part of the cost of the asset. But for my decision making, it's helpful to say, I'm going to have these costs whether I produce 5,000 cars or 20,000 cars. My fixed costs are going to be the same, and I need to separate those out because they help me in my budgeting process. That's all. Okay. They're both really valid ways of looking at the data. It's just we need to understand there'll be a difference. Okay. So this explains what we just talked about, the $30,000 difference. So under the one, all 150,000 of the fixed costs are included as a period expense. Under the other, the 3,000 units of ending inventory in absorption costing statement include $30,000 of fixed manufacturing costs. So again, we just said that, but this is it in writing, if you like it in writing. All right, what happens if the units we manufacture are less than the units sold? So sometimes, you know, if we already had units sitting there and then we manufactured a certain number of units, we might sell all of the ones we manufactured during this period, plus some of the ones that were sitting there before, right? So in this case, their beginning unit is 15,000. They manufacture 10,000, and then they sell 15,000 during the period. Okay, so they're selling everything they had plus what they made during the period. If you think about it, a lot of times that's what you'd like to do. If you could time it out just right, is sort of not carry inventory forward, just, you know, produce it just in time. Otherwise, you're storing it, it's sitting in a warehouse or something, and it costs money to store stuff. So in this case, you'll see that our net income, or sorry, operating income is 50,000, and here our operating income is 100,000. Well, why? Because under the absorption costing, we're still taking, I'm sorry, under the variable costing, we're still taking the full fixed manufacturing cost, 150,000. But up here under absorption, we are not only getting the cost of goods sold expense from all the ones we produced this period and sold, but we're also getting some cost of goods sold expense from the ones we produced in the previous period that had that fixed cost rolled into them. Okay, so we end up with more expense under cost of goods sold, and so our net income is lower. And so the takeaway is just this recognition of, if we produce the same amount of units that we sell, then our net income under both absorption and variable is going to be identical. Okay, but if we produce or manufacture more than what we sell, back to this one, then our operating income or net income under absorption will be higher than variable. Or if we produce less than what we sell, then our variable costing income statement is going to be higher than our absorption. So it sounds complicated, but if you think about it, there's really only 3 options here. So if you take a few minutes, for me as a learner, sometimes I'll sit through something like this and I'll be like, oh yeah, that makes sense. And then later I'll be like, I don't remember exactly why. But honestly, if I take a piece of paper and I go, okay, if they're the same, they equal. If this one's greater, then this one has the higher net income. Like just doing that, like locks it in for me a lot of times. So like, don't forget, your teachers understand. We've been through lots of college, okay? And like, I totally get that something like this is kind of abstract until you're working with it. And really it's kind of abstract until you work with it a lot. And in a class, you're not going to work with it a lot. You're going to work with it a lot for like a couple days and then move on, right? Anyway, so here's it spelled out. $50,000 difference is due again to the fixed manufacturing costs. Remember that under absorption, that beginning inventory had $50,000 worth of fixed manufacturing costs sitting in there as part of the inventory from the previous period. So then when we include it, we're going to have $50,000 more in expenses, just a second, which is going to give us an operating income of $50,000 less. All right, what's your question? Right? I'm not sure I understand your question. Not really, because under absorption cost, the key thing here is that we have fixed manufacturing costs included in the cost of goods sold under absorption costing. So your absorption costing cost of goods sold per unit is always going to be higher than your variable costing cost of goods sold. Okay, because in variable costing cost of goods sold, we don't have any of those fixed overhead costs included in the cost of goods sold. Instead, they're listed as a line item. So we're always taking, so with variable costing, we're always taking the fixed overhead costs as a period expense, meaning we're just going to take the full amount as an expense every period. Right. Right. So under absorption costing, when we manufacture less than what we sell, okay, that means we're selling not only the ones we manufactured this period, but also some that were already existing from the previous period. So we're getting more expense put into that cost of goods sold than what's going to be put into the fixed cost from the period, because we're taking some of the fixed expense from the previous period. Okay, does that make sense or no? Or is it like more confusing the more we talk about it? So that just explains it out. I'll let you read through it. There is no next one. There's only three. You produce what you sell, or you produce more than you sell, or you produce less than you sell. That's it. So that's why I was getting to the whole like speech about, even though it seems like a lot, there's really only three options here. So if you can go through each of those and break down what they are, it's pretty easy, like with a little practice. Like that's like this or like this. Whoops. So what's crazy about this from a financial reporting standpoint is sometimes if someone wants to make their financial statements look good, all they have to do is overproduce. And that's actually not good for the company, right? Because now you've got all these units sitting there in inventory that you haven't sold, that you're not going to get, because not only are you not getting the expense until you sell it, you're also not getting the revenue on it until you sell it. And so this is one of those areas where accountants can kind of be like, hey, we have this important investor meeting coming up. I recommend we overproduce. We produce an additional 20,000 units over what we normally need so that our income statement will look nice and fat, and that'll get investors interested in buying. And really, it's not ethical, right? I mean, you should be producing what's your normal production. I mean, sometimes you accidentally overproduce because you can't exactly predict sales, but to use it as a trick of accounting usually backfires because then you have all these units you got to sell, and who knows what could go wrong in the meantime. All right. So in summary, if the units manufactured equals the units sold, then the absorption costing operating income will equal the variable costing operating income. I like that they show little blocks. That's the stuff you're producing, apparently. And is it bubble gum? I don't know. Is it, what else could it be? What comes in pink boxes? Yeah, it's probably drugs. All right. All right. If units manufactured equal or is greater than the units sold, then our absorption costing operating income will be greater than the variable costing operating income. And you guessed it, if the units manufactured is less than the units sold, then the absorption costing operating income will be less than the variable costing operating income. It's important for this chapter that you understand that relationship. Even if you have to write it down and make yourself a little cheat sheet, it'll help. Okay, it'll just help your brain like wrap around what the problems are about. But yeah, that's just a summary of it. All right, so let's look at this little example of using this for analysis. We have the Frand Manufacturing Company. I don't know if they manufacture Frands or if that's the name of the people who own it. I make Frands for a living. What are Frands? Well, if you don't know, you don't need to know. All right. Anyway, they have no beginning inventory and sales are estimated to be 20,000 units at $75 per unit. Also assume that sales will not change if more than 20,000 units are manufactured. So we think we're going to sell 20,000 units regardless of how many we produce. Unless we produce less than 20,000, then we'll only sell what because we don't have any beginning inventory, right? In this case. So Fran's management is evaluating whether to manufacture 20,000 units, that's their first proposal, or 25,000 units. Because sometimes there's value in having some available for the next month, right? It's the worst when your customers want to buy something, you don't have any of it. So the costs and expenses related to each proposal appear on the following two slides. All right. So for proposal one, 20,000 units be manufactured. They'll have variable costs of 700,000, fixed costs of 400,000, so a total of 110,000, and then selling and administrative expenses. Yeah, what was there? Did it say how much they're going to sell them for? 75. So what's the revenue? 20,000 times 75. 1.5 million minus 1.1 million in costs, which is 400,000 minus 200,000 in selling administrative. So they're gonna make $200,000 profit. Here, if they produce 25,000 units, remember their sales won't change, but we have variable costs, fixed costs, okay, or I'm sorry, manufacturing costs and selling and administrative costs. All right, so here we can look at their absorption costing income statement side by side. Remember, absorption is the one that we would use for public reporting, okay? So 1.5 million in revenue either way. We have our cost of goods sold, which is our cost of goods manufactured, minus our ending inventory. So you can see under absorption costing, even though we produced more, do you have your hand up? Okay. Even though we produced more, our cost of goods sold is actually less. Why is it less? Can anybody tell me? The variable costs are the same. Let's go back. So here, look, with 20,000 units, our variable cost is $35 per unit, and our fixed manufacturing costs are $20 per unit, giving us a cost of $55 per unit. With 25,000 units, our variable costs are still $35 a unit, but our fixed costs, because they're being divided by more units, actually are less per unit. Because fixed cost is fixed. It's not going to change by producing more. But our fixed cost per unit then is going to drop as we produce more units, okay? So under absorption costing, because we're rolling this fixed cost into the product cost or the cost of goods manufactured, then our cost of goods sold actually appears to be less, even though our actual costs were more. Does that make sense? Because we had to still pay that fixed cost. So again, by overproducing in this scenario, manufacturing more than what we sold, our operating income is, you could say, artificially higher, okay? Where's that $80,000 difference? Well, it's sitting there in the 5,000 units of inventory that is gonna, but we'll have that expense. That expense will just come up next month when we sell those, okay? So we could increase our operating income by $80,000 by simply increasing finished goods inventory by 5,000 units. But what I would like to tell you is that's not the reason why we should do it. If we have a good reason, like it would be a good idea to start the period with 5,000 units of inventory so that we always have enough, that's a good reason. But because it's going to make our net income look higher, even though it's not really, because we still are going to have those costs, that's not a good reason. Right. So that is, if you learn better by reading, that's what I just said, but in text. So I'll give you a minute to look at it if you want. I know this seems a little complicated. I promise you, it's not too bad. Okay. Under variable costing, the operating income would be 200,000 or 200,000, regardless of whether we produce 20,000 or 25,000 units. And that's because we're not allocating any of those fixed costs to the unit costs. Instead, we're just going to take them as a period cost. So here's an example of whether we produce 20,000 or 25,000 units or 30,000 units. Under variable costing, our operating income's the same. The only difference would be on our balance sheet, right? We would see more units of inventory sitting there at the end. It's again, neither one of them is a loss or a gain or anything like that. It's just, in the one case, we're pushing those costs forward to the future period under absorption because they're sitting there in inventory that won't be sold until a future period. Whereas under variable costing, we are claiming that expense right now during the period as a fixed manufacturing cost. That's the only difference. That's all right. Hey, if you learn best by just puzzling through it for a minute, I'll wait for a minute so you can look through it. Right. Yep. So, well, yeah, on a balance sheet, you're not writing costs. You're just putting the value of the asset inventory at the end of the period. And so under one scenario, if you sold 20,000 units, you'd have zero inventory at the end of the period. The next one you would have right till they're sold. Right. So cost of goods sold don't become an expense. So cost of good manufactured doesn't become an expense until it's cost of goods sold. So if you think about it, the cost of goods manufactured in any period is just going to be the cost of the goods sold plus the cost of any goods in ending inventory. Those two will equal up to the cost of the goods you manufactured. Well, minus what you started with, but yes. Yes, so under absorption costing, that's why they call it absorption, which I think is a weird term, but it means all of the costs, the manufacturing costs are absorbed into the cost of goods sold, or the cost of goods manufactured, which becomes cost of goods sold when you sell it, as opposed to under variable, where the fixed does not become part of the cost of goods sold. So the use of absorption and variable costing gets used a lot in these type of decisions. Okay, so when we're making decisions about how to control costs, we can sometimes see our costs better when we use variable costing than when we're looking at absorption, because it breaks them all out, right? And we can say, because here's the thing, when I have to, if I'm a business manager and I want to control my costs, the way I control fixed costs and the way I control variable costs are very different. So think about even something like the college here and the way we operate. A fixed cost might be the cost of the utilities, okay, or the cost of grounds maintenance. Whether we have 2,000 students this semester or 3,000 students, we have to keep the grass looking nice the same way, right? We have to mow all the lawns, keep them watered, pay the people to do that. And so that's a fixed cost. It's not variable with relation to our revenue source, which, sorry guys, but you're a revenue source, okay? Like, wait a minute, is that all I am to you? No, you're a beautiful, independent soul, but you do generate revenue for us, right? Whereas other costs, I'm trying to think of a good one, maybe like our Canvas system, which we have to pay kind of a per user sort of fee to Canvas, okay? That's purely variable. The more students we have, the more Canvas accounts we have to create, and the more that cost is. Now, in real life, it's actually a mixed, but we won't get into it. There's a certain, we pay them a certain fee plus a certain amount per the number of students, and it's actually tiered. So if you're between, 1,000 and 3,000, it's this much, and so forth. But let's just consider that it's a variable cost. So the only way I can control a variable cost is either to reduce what's driving it, which in our case is also what's driving our revenue, so that doesn't make sense, or find a new supplier, right? In the case, we'll go to Blackboard and see if they'll do it cheaper or something like that. And that's kind of the only ways I can control those things, is reduce volume, which often isn't a good thing for us, or change suppliers. If you're a manufacturer, the question is like, do I produce it myself or do I outsource it to Malaysia, right? Or like you were talking about with your mom, buying stuff from China that she uses for her business. But with fixed costs, it's totally different. Okay, what can we do to lower the fixed costs? Is usually large scale changes, like maybe we decide we're not going to have these nice lawns and instead we're going to like xeriscape and we're going to have desert. We spend a butt ton, that's the accounting term, of money on water, believe it or not, to keep our lawns so nice here at the college. Even like that little box out front, I used to have these beautiful flowers. Now I got like a cactus. So what they were doing is they were trying to save money. And so they've been going through, and the areas that they can kind of let do that with, they're doing that. And they're just keeping these sort of like certain grassy areas as grassy areas. Okay. That's one way the college has tried to reduce fixed costs. Well, that doesn't happen. You can't just change fixed costs on a momentary notice. It takes months of planning and even years sometimes. And like one of our big things at the college has been, we've been getting rid of faculty, but not firing anybody and not laying anybody off. Just as people retire, then going to that area and saying, can you cover the classes you have with one less, or can you even dial back a couple classes, but still fit all the students who need them? So instead of maybe having 18 people in an English class, we'll shoot for having 25 people. That's a way that we can kind of cut the fixed costs of faculty by by doing more with less. All right. Anyway, I just gave you a big spiel. Sorry if I talked too much, but the idea is we use these principles all the time in controlling costs, in setting our prices. We need to understand our prices. So understanding our variable and our fixed costs can really help us understand how to set our price, right? If you think about the whole idea of contribution margin, we need to know what the variable cost is and have a good estimate of sales volume so that we can then set a break even and set a target profit. Okay. Planning productions or planning and analyzing market segments. Like if we're comparing the EAC's Thatcher campus to our Payson campus to our Globe campus, this sort of analysis can allow us to make meaningful comparisons. So I guess this is just like telling you, this is what this is for, and why we have to understand that there's this difference between the two, because we have to use both of them. And that's important. Oh, and then one more concept is this concept of controllable costs. Okay. Recognize that at certain levels in an organization, managers only have decision-making capacity to control certain types of costs. For example, as a division chair, I can decide how much we're going to spend on supplies and marketing and things like that for our division, but I don't really have control over my labor costs. I can't fire or hire faculty directly. And so my labor cost is my labor cost, and I have to live with it. The decision-making tier above me, the vice president, she could decide. Now, I could be consultative. I can go and say, hey, I think we can do this with one fewer instructor. So we know Tom's going to be, retiring next year. Let's not hire a new person. Let's just do it with what we have. So I can consult there, but I don't have the decision-making authority. So just know that when management at a given level has decision-making authority over costs, we call those controllable costs. And the ones that they don't have control over are non-controllable costs. But usually what one person's non-controllable costs is another management tier's controllable costs, right? The president of the college can make all decisions about hiring, firing, and other costs. So just recognize that, because you'll probably find yourself in management at some point, and it can be very frustrating when there's costs that you have zero control over, but that are really cutting into your margin, especially when your bonus is based on your margin. All right, that's it for this chapter. On Friday, we'll do a guided problem, and that's all I have today. So have a terrific day.